Thank you for joining us for our session on navigating new opportunities, helping small business claim the Employee Retention Tax Credit. This webinar is part of a 6-part series on workforce-related topics supported by Gordon Food Service. GFS is a great partner of WRA's with valuable business solutions for you to consider. This webinar is hosted by the Wisconsin Restaurant Association, dedicated to the success of the food service and hospitality industry. WRA serves as your primary resource for regulatory guidance, training opportunities, and solutions to relevant challenges. Just a couple of housekeeping items before I turn things over to our speakers today. Feel free to submit questions using the chat box or Q&A feature found at the bottom of your screen. We'll get to most of those at the end of the session. The webinar will be recorded and sent to you in the next day or two. And most importantly, prepare to learn how you can get money in your pocket. I will now introduce our presenters who have made today's session possible. We have with us today Rich Adams, Payroll Division Manager with Heartland Payment Systems, and Tony Jalen, Division Manager of Sales, also part of the Heartland team. Rich and Tony, I will now turn this session over to you.
All right, well, thank you very much, Amy. We are very much glad to be here with you all today, and really excited to just bring more awareness around the topic of the Employee Retention Tax Credit. I'm joined here with Rich Adams, almost a few decades of experience working with human resources, payroll, and he's going to really share a lot of different things with you guys in terms of the Employee Retention Tax Credit. What brought this to the forefront is sitting in different meetings with numerous business owners, doing a quick survey and asking them how many of you have taken advantage of this Employee Retention Tax Credit, with less than 10% raising their hands. I feel it's very important to be an advocate for the small business owner and to share this with all you guys here today. So there's really been 4 big questions when it comes to understanding the basics of the Employee Retention Tax Credit. What is the Employee Retention Tax Credit? Some people think it's a deduction. It's not a deduction. How do businesses qualify for it? Claiming credits and other considerations, as well as what is the recovery startup business? So you are going to want to grab yourself a notepad. More likely you will have questions that will come up throughout the presentation, and our goal is to be able to answer those questions at the end if they're not covered during the presentation. So first off, Rich, what is the Employee Retention Tax Credit?
Yeah, Tony, great jumping off point. And Amy, thanks for having us. We're really looking forward to sharing our knowledge on this. And like Tony mentioned, I've got just about 3 decades of experience with payroll and HR in the industry, specifically working very closely in the hospitality space. So I'm eager to bring our knowledge to the Wisconsin Restaurant Association and share with you what the Employee Retention Tax Credit is all about, and also dive into some other areas you may not be familiar. So Tony, good jumping off point. What is the Employee Retention Tax Credit? So the Employee Retention Tax Credit, I will refer to it as ERC, was offered as a refundable tax credit to businesses when used against certain employment taxes equal to 50% of qualified wages and employer health plan expenses paid from March 12th of 2020 through December 31st of 2020. That would be what we would probably remember as the dark period of the pandemic when things were shut down. And then it was updated based on the Consolidated Appropriations Act, which extended the credit through June of 2021 and increased the amount to 70%. So a lot of language there. I think the important emphasis is on both the 50% of qualified wages and employer health plan expenses for 2020 and the 70% increase in 2021. Then,
so Rich, real quick here. You know, I was sitting down with a business owner probably like 3-4 months ago, and I brought this up to their attention, and they're like, "Well, Tony, I don't need to take any more deductions. You know, I maximized all the deductions." And one thing you say here is it's offered as a refundable tax credit. So does that mean I'm actually like getting a check in the mail if I qualify from the government for this?
Absolutely, and great question. I compare this a lot to your individual tax return. If you get a credit or you get a refund, you get a check back from the government, and works exactly the same way. So we'll talk about exactly how to claim those credits in a bit, but you're 100% correct, Tony. This is a refund. This is not a credit that you take on your corporate tax return.
Wow, that's awesome.
So they made one other revision at the beginning of this year under what was called the American Rescue Plan, which had much other provided relief. This was the utilization of the ERC first outlined in the CARES Act, was extended and modified a second time with the passage of the American Rescue Plan that was signed in on March 11th. And eligible employers are now able to take advantage of this credit through the end of 2021. Now, I want to put an asterisk here because there's still some legislation I'm sure many of us have heard about with regard to the infrastructure bill that's caught up in some place between the House and the Senate and the president's desk on whether or not it gets signed into law. There was a provision in there that would disband or do away with the employee retention tax credit. Because this has not been signed into law yet by the president, the ERC is still available to be applied to eligible employers through the end of this year. Okay.
So one of the things is that I heard that, is it true that employers may be eligible for up to a 70% refundable payroll tax credit against qualified wages?
That's correct. In 2021, eligible businesses would be able to apply for 70% refundable tax credit against qualified wages. And Tony, you might be asking, what are qualified wages? What's included? Well, for all of the business owners and restaurant owners and owner operators on this call, you all know what gross wages are. Those are considered qualified wages, but the government went one step further. And if you're an employer who offers health insurance to your employees, and under health plan that does include dental, vision, you are allowed to include your share, the employer's share of employer health plan expenses in those qualified wages. So a really big opportunity, and where we've been seeing in the industry and specifically to our Heartland clients, we're seeing on average where businesses are able to receive substantial credits because their payroll is so high. So how do we figure out what these wages are? Well, as we mentioned, it's 70%. It's applicable to the first $10,000 of wages per quarter for each employee, which equals a maximum tax credit if the employee earned $10,000 or more of $7,000 per employee per quarter. So if you're doing some quick math, Tony, or the owner operators on this call, this adds up very quickly.
Yeah, it does.
And we're seeing within our company, in our client base at Heartland, the average client with all quarters combined are seeing just about $80,000, Tony, in refundable tax credits. So it's pretty substantial.
That's a check. And that's a check.
That's a check.
That's like cash infusion into the business, which is absolutely mind-boggling. I remember talking to you and some of the other experts on our team going, okay, wait, what am I missing here? And you're like, you just got to ask about it. That's one of the biggest things.
Correct. It's exactly right. And I think, Tony, you and I were speaking, before the call, and it's important to point out the IRS and the federal government doesn't have a marketing department. They let these laws go out there in front of us. They don't really market them, right? These rules are out there, and it's up to the business owner who are doing 1,000 other things in their day-to-day lives to really sift through the law, sift through what they're eligible for, and then figure out if they're even qualified. And this is where businesses like Heartland and others out there can assist and guide, owners, operators to figure out what they're qualified for. So continuing down here, all the buzz last year was around the Paycheck Protection Program loans, the PPP as it was referred to. And when this law for the employee retention tax credit was released, you could not if you received your first draw of PPP, you could not use ERC in the year. Well, they have since modified that, and you can now take the employee retention tax credit with a PPP loan. However, the time period that you use the PPP loan for payroll, those wages are not qualified. So it's a little bit better, as it's not completely, the PPP loan does not disqualify businesses from applying for these credits. They just can't use it for the time period that they had the PPP. Okay.
So I guess the next question is, speaking of qualifying, then how does actually a business qualify for this? Like, what it would be like the check marks I would have to check off of my checklist to see if I qualify for it or not?
Yeah, great question, and very important. And this is what I would consider to be one of the most important screens in our deck here this morning. So important to understand that a business, and specifically in the hospitality space, I think this applies to most businesses. If your business operations were partially or totally shut down due to a government order, either federal, state, or local, you qualify. And this includes restrictions on capacity and or social distancing requirements. So I'm here on the East Coast, and you know, it was interesting. There was a lot of I'll just say political noise around this, where in the state that I live in Pennsylvania, where they lifted the government order that businesses were shut down, yet they still maintain, the government still maintains social distancing requirements. Well, in the hospitality space and the restaurant industry, real estate inside your restaurant is prime, right? So if you're forced to keep tables or bar stools 6 feet apart, you are limited, and therefore you qualify for the ERC. So it's important to understand that this first bullet point practically applied to almost 100% of businesses in the hospitality space, strictly because there was a federal, state, or local government order restricting your capacity.
And this is a good thing to point out, because in some of my conversations, some people thought it was simply only federal. But like in Wisconsin, for example, I'm looking at some of our attendees, they're all in different areas of the state. And we had not only the state issued mandates, but also local municipalities were issuing different rules as well.
Yeah, and the government provided, the IRS, the federal government provided very specific language that it is any government authority. So that's why it's important to understand that your local municipalities, if they are a government agency that has governing authority over businesses in the county, in the town, wherever they're located, that they imposed restrictions, those businesses in that municipality or that county would qualify. So it's important to understand that this impacts a number of our owner operators on this call here today. And Tony, I'll jump ahead to the second point, that there is a second component to this. So maybe after restrictions were lifted and an owner operator was back to full capacity, there was no social distancing guidelines, you still may have an opportunity to qualify for the ERC. So in 2021, if your gross receipts are less than 80% when compared to the same quarter in 2019, you qualify. And some of our participants might be wondering, well, why is it compared to 2019? That is the year, obviously, pre-pandemic, pre-shutdown, pre-lockdown. So what the government allows an owner operator to do is to compare, hey, where were my gross receipts during the partial shutdown or total shutdown? And how does that compare to pre-pandemic gross receipts? And if it was less than 80%, you qualify. Now, we also might have some business owners on the call. They're wondering, well, I wasn't in existence in 2019. How do I apply this? Those business owners would be eligible to compare those to the same quarter in 2020. So two very distinct qualification standards here. The third bullet point that I want to bring up, Tony, and point out is a business owner operator only needs to qualify for one of the two. Okay, they don't need to meet both criteria. And the last point I will bring up here is very important. The government put out these regulations, as I mentioned before, and we're sharing with our participants this morning. This is a self-certified program, okay? The laws and the rules are on the IRS website. They're out there, they're available. It is up to the owner operator, along with their tax professional or their business advisors, to determine, do we qualify? Obviously, I have many years of experience and have been studying the employee retention tax credit since its inception. And I can say with most confidence that you may qualify if you reach one of these, meet one of these qualification standards above. However, it is incumbent upon the business owner to determine if they qualify or not. So I'll pause there, Tony.
And there's resources that the IRS provides in order to go through that, so they can go through either their tax professional or someone along those lines to help guide them through that.
Exactly. And likewise, I would imagine that many business owners on this call, participants on the call, not only work with an accounting firm or CPA or a business advisor, they probably work with a payroll company. There are many of us out there. Payroll companies like Heartland and others are very well versed in these rules and regulations and can provide, answers and guidance when approached.
So what about claiming the actual eligible credit? So you meet some of the criteria here. What steps have to be taken in order for me to claim the eligible credits then?
Yeah, great question. And this is important to understand, and forgive myself here as we move forward and I get a little payroll, I like to call it payroll geekdom, but we're going to go into it. Because obviously 2020 has closed, the quarters in 2020 have closed when the employee retention tax credit was created, and first and second and even third quarter have closed in 2021. In order to claim your credits, the business owner will need to file what are called amended returns, 941Xs, and that is how you're able to go back and claim the credits. Now, it's important to note that the employee retention tax credit and the 941X is a paper filing using the United States Postal Service. So it could be a lengthy process to claim the credits. And the more knowledge, the more business owners that begin to understand the, really the magnitude of this program, the government is experiencing greater than normal volumes. I'll just put it that way. A really important point that I want to share with our participants this morning is, even though under current law and language, the employee retention tax credit is set to expire on December 31st of this year, it doesn't mean that you are no longer allowed to claim your eligible credits. An amended return, or the 941X, can be filed up to 3 years after the close of a particular quarter. So if you want to go back and claim 2020 credits, you have until 2023. Likewise, 2021 credits can be claimed up to 2024. So this is an important factor to understand in realizing these credits. Just because there's an expiration date on the program does not mean that there's an expiration date on how far, well, there is, but it's 3 years out that you can go back and claim these credits.
Right.
For those businesses on the call and others that are listening, if you are eligible in the fourth quarter of this year, the IRS has made it very easy for you to claim the credits each pay period. And what that means is you can actually reduce your federal tax liability deposit each pay period based on your credits accumulated in that pay period. And that's probably a little bit in depth in terms of the payroll language, but what the government allows qualified businesses to do is get an immediate cash infusion as opposed to waiting for that refund check in the mail. And if business owners are using a payroll company, most nationally accredited payroll vendors are able to do this on a per pay period basis. Heartland is one of those, and we're able to actually get clients that are still eligible these credits each pay period.
So I understand that there's some important considerations when it comes to this, in terms of owners, shareholders, etc.
Yeah, and these are equally as important. And I go through these as, what I'll say is pump the brakes, if you're an owner operator on this, as we go through these and evaluate it, because again, as I mentioned earlier, this is a self-certified refund credit program. So you need to know all the rules so you can apply them appropriately. So the first one is an important one, specifically if we have owners, shareholders, or partners on this call. If owners, shareholders, partners, and family members are on the payroll, those wages are not eligible. And this is critical. I've worked with a number of clients who, they have a number of family members on the payroll, husbands, wives, daughters, sons, etc. Those wages, unfortunately, are not eligible for the employee retention tax credit. I'll apologize in advance for all the abbreviations, but those of you out there who are taking advantage of them, the abbreviations you see before you, if you've taken advantage of PPP, EIDL, FFCRA, sick pay, work opportunity tax credits, and other government-sponsored tax credit programs that you use for payroll, those wages that you covered with one of these government programs are also not eligible. I mentioned it earlier with the Paycheck Protection Program loans. It also extends out to the others that you see before you. So my recommendation here to all our audience here this morning is, if you took advantage of one or all of these government programs, work closely with your tax advisor, your accountant, to make sure you're not what the government refers to as double dipping on the credit.
So could you give an example, like WOTC stands for Work Opportunity Tax Credit, for those who are hearing it for the first time? Like, what is that? Yeah, explain that.
Yeah, that's a good question. Work Opportunity Tax Credit is, again, one of those underutilized government programs that many of our owner operators on this call today probably qualify for. Is if you hire an employee that would qualify for a work opportunity tax credit. And these credits, Tony, range anywhere between $1,500 and $9,600 per employee, depending on a variety of classifications. Long-term unemployed, disabled, former military, all are various qualifications for the work opportunity tax credit. So if you've hired one of those individuals who qualifies for those work opportunity tax credits, and you're taking advantage of it, that employee would not qualify. So again, there's that double dipping provision.
So that'd be example, I have 10 employees, 2 of them, I'm utilizing the work opportunity tax credit, WOTC. In order for this program, I'd only be able to use 8 of them for it then.
Exactly. Yep. Well said. Our third bullet point gets into size considerations. And I'm going to break this down, Tony, into two bullet points. First, I'm going to talk about 2020, and then we'll talk about 2021. So in 2020, it was somewhat restrictive, especially for our large owner operators on this call who have multiple establishments. Employers in 2020 who had more than 100 full-time equivalents employees are not eligible. Now, a full-time equivalent based on the definition is an employee or a combination of employees that equal 30 hours per week. Okay, so FTE, full-time equivalent, is 30 hours per week. You may have an establishment where you employ a lot of part-time people. The combination of those people is how you arrive at your FTE calculation. Now, what was very nice about this consideration is the government realized that 100 FTEs, specifically in the hospitality space, is rather limiting. A lot of restaurant owners, a lot of multi-establishment restaurant owners fall under what's called the aggregation rules. Without getting too detailed, that means that if you own multiple establishments under the same ownership, they have to be combined. So the government recognized that. And in 2021, it's our next bullet point here, they increased the limit of FTEs to 500. So if you have less than 500 FTEs employees in 2021, you are eligible. However, if you cross over that threshold, you are not. And I stress here that this includes common ownership of multiple establishments. And that can mean Tony and I own one restaurant, but Amy and I and Tony own a third restaurant. All of those restaurants need to be rolled together to count up the number of employees. So important considerations for sure. And again, this is where I stress, work very closely with your accountant, your business advisor, to verify if you have or if you qualify based on these criteria.
So this really helps out. This employee retention tax credit really does help a lot of people who've been established in business, that they were in business, prior to the pandemic starting. But what about those business owners who decide, let's swing for the fences, and they started their business, rolled the dice, February 15th or later in 2020?
So my condolences to them, but I joke, but congratulations if you are one of those business owners that like you said, Tony, rolled the dice and started during what was the pandemic. And the government created a provision for the employee, or in the employee retention tax credit law, which has created a separate classification, what's called a recovery startup business. And this is actually a very, very lesser known and underutilized program. And I'm going to walk you through who is a recovery startup business and how do they qualify. So if you are an owner operator, a business owner operator on this call this morning, and you began your business after February 15th of 2020, you are by definition a recovery startup business. If you are a business that started after February 15th and you generate $1 million or less in gross receipts, you're eligible, or you would potentially be eligible for the recovery startup credit. It is also not a requirement that you meet the comparison, what we call gross receipts requirement that we talked about a few slides earlier, comparing your 2021 gross receipts to 2019. And you would not otherwise need to be eligible under the other conditions, including suspension of business operations or capacity limitations. What does all that mean, Tony? That means that if you started a business during the pandemic and your gross receipts are not expected to exceed $1 million, you would be eligible for the recovery startup business tax credit. So what is it? How does it operate? It is very similar to the employee retention tax credit. And what do I mean by that? Same rules apply. 70% of the first $10,000 in eligible wages per employee per quarter, or $7,000 per employee. The recovery startup business does have a limitation that the employee retention tax credit does not. The RSB qualifier limits that business to a total credit of $50,000 per quarter. So there is a definitive cap on what an RSB business owner can claim. And the final bullet point here is the recovery startup business is only available in the third and fourth quarters of 2021. And we get a number of questions around this, Tony, about why is it only limited to third and fourth quarter of 2021? Well, the thought process of the government was chances are you were operating in a state where restrictions were imposed upon you in first and second quarter of this year. So they said, we'll extend it into third and fourth quarter if you are one of these RSB businesses, and allow you to claim the credit even after restrictions were lifted. And just as before, if a quarter is closed, for example, third quarter closed at the end of September, a business owner would use the 941X to claim that credit for all closed quarters. And the three-year window also applies.
Richard, like you said at the beginning of the call, it's not like the government has this big marketing plan that's advertising on TV and radio and internet. Hey, take advantage of this program. And it's interesting. I had a coffee meeting with one of my accountant friends, He's like, I'm so wrapped up in the PPP stuff yet that I haven't even dived into the ERC yet, Employee Retention Tax Credit yet.
Right.
And I find that happening often out there in terms of it. So I think, back to your 3 bullet points you said at the beginning of the call, like how does a business qualify? If you're partially or totally shut down due to government order, you said, right?
Yep. I'll get back up to it.
2021 gross receipts are less than 80% when compared to the same quarter. And the third one was?
The third one is you don't need to have both. You can just qualify via one. And, I think you touch on a very important point here, Tony, is there many of our accountant partners and our CPA partners across the country have been bogged down with a number of pieces of legislation that affect just normal individual tax returns, business returns, et cetera. And they haven't had an opportunity to really dive into the employee retention tax credit and all of the provisions in it. I would recommend to our business partners on the phone here today that, definitely lean on your accountant, but also lean on your payroll providers. We are well-versed in it. We understand it. We can provide guidance. We will give you the laws as they are written and help you navigate qualification standards or not. I think business owners, again, have so much on their plates today. This is a credit that we're seeing every day. Business owners take advantage of it, earn those credits, and as you mentioned earlier, Tony, get those checks in the mail. So it's a substantial credit, and I feel very blessed and fortunate to be in front of this group here today, sharing this knowledge, because I want all American-owned businesses to take advantages of all the credits that they have at their fingertips. And I'm very fortunate that I work in an industry that can help small businesses, Tony, as you do as well. And bringing this information to the audience here this morning really is important. And I think it's important, Tony, here to highlight how they can get more information following our call here today.
Yeah, absolutely. And simply, you can do it 2 different ways. You can go to heartlandwra.com, or you can simply text Heartland to 414-409-0087. And again, part of our role is be an advocate for the hospitality industry and just educate you on this and let you know it's available to you. Because we see many people from around the state that are on the call, and big kudos to the Wisconsin Restaurant Association putting this on, because this is a thing that people are missing out on. And when all of a sudden you dive in and have the conversation around it, eyes get wide going, oh my goodness, like I could have literally left this on the table. And with how everyone was impacted last year, why leave it on the table if you don't have to? Simply just invest that extra time to do it. So now it's time for questions and answers. Amy, I'll hand it back over to you.
Thank you, Tony. Thank you, Rich, so much for presenting today. I appreciate you both, and you've been a fun duo to work with too, so thank you. I'm going to go ahead and say goodbye to our Facebook Live audience, and we'll go ahead and get into some questions here. One of the questions is the sales comparison based on the individual locations or based on reporting entity for the quarterly 941 filings?
That's a good question. And I would answer it this way. Sales are tied to the employer federal identification number, so the entity itself. So they would be comparing quarter over quarter 2021 or 2020 to the same quarter of 2019. And what we're really finding is they're taking their sales numbers and they're working closely with their tax professional to make sure that they meet that standard. So, and the second component, Amy, if you could repeat that regarding the 941, what was the second part of that?
Sure. I'm going to read the whole thing because it goes together. I think it'll make more sense. In the sales comparison based on the individual locations or based on the reporting entity for the quarterly 941 findings.
Okay, yeah. So it is the reporting entity, which is the federal identification number.
Okay, thank you. So we're going to give everybody just a moment here if there's any questions that they want to ask. Sure, there's a lot of digesting of information here. I'll just give everybody a second.
And while people are answering their questions, I want to congratulate everyone for jumping on this call, because even if you have taken advantage of it, it's good to share the news. We got to go ahead and share it with other owner operators, because people need to know about this, whether you start your business in after February 15th, 2020, or you've been around for a while. Like, the more people are talking about this, the more people we can help.
Well said.
We do have another one. Is the credit taxable income?
That is a very good question. This is a taxable event. That is what I'm allowed to tell you. And because it is a refund, there is a tax implication. So I would redirect you to your accounting professional for how it impacts your corporate taxes and your corporate tax return.
Perfect, thank you. And I know you touched on this a little bit with a little warning that this is going to take some time. So I have someone asking, what is a realistic time frame to receive the credit after filing the 941? They filed it 3 months ago for the Q1 2021 941 and have not received any checks or notifications or anything quite yet.
Yeah, that is a great question, and a real world example that we are seeing delays of 6 to almost 8 months. So the government is backlogged, but we are beginning to see first quarter amended returns for 2021. We're beginning to see those refund checks arrive in our clients' hands.
Thank you.
Good questions.
We'll give it just a moment here again to see if anybody wants to jump in before we conclude. And here's one. If the business qualifies because they are closed during part of the second and third quarters, they would qualify for the credit for those quarters. The other quarters, they would need to meet the 80% rule. Is that correct? Do you want me to repeat that?
If you don't mind.
If the business qualifies because they are closed during part of the second and third quarters, they would still qualify for the credit for those quarters, and the other quarter would then need to meet the 80% rule. Is that correct?
So I will answer it 2 ways, because there are 2 qualification standards, either an imposed government restriction on capacity limitations. So even though they were open during the quarters that they're trying to meet their gross receipts test, they may still have federal or state local mandates to have tables separated by greater than 6 feet, bar stools 6 feet apart, etc. If there are any limitations imposed upon them, they would qualify. If there are no imposed government restrictions, then they could go and do the 80% gross receipts test. So it's an either or scenario. Just because they were shut down means they qualify, but they also may qualify if they were open but operating under a restriction.
Okay, thank you. And again, we'll just give it a moment in case somebody's hurriedly trying to type something in here. But like Rich mentioned too, heartlandwra.com, or the number that Tony shared for the texting. And I will include this slide deck. So all of you that are on this call, you will get this slide deck along with the recorded link. So you'll have all the information as well. Here's another one. If we receive the RRF funds, would we still be eligible for the ERC credits?
Really good question. And that was one of the acronyms I didn't include on my bullet point, but RRF, if those funds were received and if they were used for payroll, the time period that you use the RRF funds, because it is a government sponsored program, you would not, those wages that you used RRF funds for would not qualify.
Okay, thank you.
Sure.